No, sir. What do you mean, sir? No, sir.
So in that case, let's start with Ferrari. Two of the three illustration outstanding involve project specific. Like I promised you when we had cost of capital, I mentioned to you that we are going to solve more illustrations that involve project specific when we get to capital investment decision. All right. So let's start with Ferrari PLC. So after Ferrari, we move to Telemundo. Then after Telemundo, we move to Femi Appliances. All right, and that will be the end of capital investments or capital budgeting. Yes, I need one of you to be my caster tonight. Yes, preferably I would like to have um, an international caster. Okay, like BBC, uh, Sky News. Okay. Any one of you who is helping us to read it. If I can't find any international caster, I wouldn't mind. All right. If I can have NTA or Chinese caster, yes, that's okay. We'll manage it. Yes. If I don't see any volunteer, I have to choose among you.
Okay, let me read.
Thank you. Lolade from BBC. You have the floor.
Okay, Ferrari PLC, a listed company based in Warri, Delta State, has been involved in producing boats excluding the engines. The company is now considering diversifying into production of a major component of outboard engine. For this purpose, the company has recently purchased the patent right for 15 million to produce the components. Ferrari has spent 20 million developing prototypes of the components and undertaking market studies. The research studies came to the conclusion that the components will have a significant commercial potential for a period of 5 years, after which newer components will come into the market and the sales revenue from the components will virtually fall to zero. The research study have also found that in the first 2 years, the development phase there will be considerably training and development costs and fewer components will be produced and sold. However, sales revenue is expected to grow rapidly in the following 3 years, that is bracket the commercial phase. It is estimated that in the first year, the selling price will be 2,000 naira per component, the variable cost will be 800 naira per component, and the total direct fixed cost will be 6 million naira. Thereafter, while the selling price is expected to increase by 8% per year, the variable and the fixed cost are expected to increase by 5% per year for the next 4 years. Training and development cost are expected to be 120% of variable cost in the first year, 40% in the second year, and 10% in each of the following 3 years. The estimated average number of outboard engine components produced and sold per year is given in the table below. That's year units produced: 15,000 year one, 40,000 year two, 100,000 year three, 120,000 units year four, and 190,000 year five. Machinery costing is 480 million will be needed to be installed prior to commencement of the component production. Ferrari plc has enough space in its factory to manufacture the components and therefore will incur no additional rental cost. Tax allowable depreciation is available on the machinery at 10% on straight line basis. The machinery is expected to be sold for 160 million at the end of 5 years. The company makes sufficient profit from it. Other activities to take advantage of any tax laws relief available from this project. Initially, Ferrari plc will require additional working capital for the project of 20% of the first year sales revenue. Thereafter, every ₦1 increase in sales revenue will require a 10% increase in working capital. Although this would be a major undertaking for the company, it is confident that it can raise the financial requirement for the machinery and the first year working capital. The financing will be through a mixture of a rights issue and a bank loan in the same proportion as the market value of current equity and debt capital. Any annual increase in working capital after the first year will be financed by internally generated funds. Coscaris plc is a listed company involved in the manufacture of outboard engines components for many years. Additional information: extract from statement of financial position. We have the working capital and
Leave
stuff.
those
So,
ones.
okay. The loan notes of Kosari plc are quoted at ₦102 per ₦100. Other data: tax rate applicable to Ferrari plc and Kosaris plc 20%. It can be assumed that tax is payable in the same year as the profit on which it is generated. Estimated risk-free return rate is 3%. Historical equity market risk premium is 6% required. A. Given the information on Kosari plc and the project financing mix, including any other relevant information, calculate the project specific cost of capital. B. Assess whether Ferrari plc should undertake the project of developing and commercializing the major component of outboard engine, assuming a discount rate of 20% has been applicable for the assessment, irrespective of your calculation in A above. C. State any three relevant assumptions made for your calculation in A and B above.
Yes, thank you very much, Lolade. Yes, that is the question. Somebody is sending in a message. Okay, Charity, why is the question long? Okay, Charity, I want you to understand that this is a professional level, all right? It's expected. Usually, when you see long questions like this, you don't need to get scared. Intentionally, examiner, they like to make compulsory questions voluminous, even though the relevant information that you need in the question may not be more than even less than a page, but intentionally they will want to make it so much voluminous, 2 pages, at times 3 pages, just to throw you off balance. But if you know what you are doing, you know that you can tackle the question headlong. There is nothing in any question, provided you have prepared very well for the exams. All right. So, like I said, intentionally, examiner like to make compulsory question big, so that in order to create fear in your mind. But if you are confident enough, if you have practiced enough, if you have exposed yourself to several practical questions and answers, certainly you have nothing to fear. All right, you have nothing to fear. Okay, now without wasting more time, all right, so let's solve this. In the A requirements, examiner is asking you to calculate project specific cost of capital, 5 marks. So this requirement is very direct, because your examiner has already told you what you need to do. All right, you want to calculate project specific work. What are you supposed to do? Step 1, you identify proxy bidder. The main company in this question is Ferrari plc. You also notice when Lolade was reading it, another company was mentioned, which is Coscharis plc. That means Coscharis is the proxy company. All right. So even the examiner did not tell you, to calculate project specific. At times you may be told to calculate appropriate cost of capital. So you should be able to deduce from the company, from the question, what kind of cost of capital do you want to calculate? So in case you are not told in the requirement, just as it is, that you should calculate project specific. So when you go to the first paragraph of the question, you will see that information there that the company is diversifying. Because in the second sentence in this paragraph, in the first paragraph, we are told that the company is now diversifying into the production of a major component of outboard engine. So that means because the company is diversifying, it means you need to calculate project-specific work. Okay. So just in case examiner did not tell you in the requirement, but now you know, of course, which is consistent with what I've told you already in class when I was explaining the concept. So we want to calculate project-specific work. We said there are 5 different procedures you are expected to carry out anytime you want to calculate project-specific. The first step is to identify the proxy beta. I will then go to the question, what is the proxy beta of Costaris? What is the beta of Costaris? When you look at this table, in the last line item you have in the table, we have beta of 1.8 for Costaris. You don't need the beta of the main company for anything. Whatever you want to do under project specific or under Wakoka, you don't need the beta of the main company for anything in case you are given, because that beta has nothing to do with the risk of with the business risk that you want to measure. All right. So it is the proxy beta that you need. So in this case, the beta of Costaris is 1.8. All right. Then step 2 says you should ungear the beta if it is geared. And I explained to you that the beta will be geared if the proxy company has debt in its capital structure. Still on this table, you will see that the proxy company has 5% loan note of 368 million naira. Aisha, you are writing on my screen. Okay, so Kosharis PLC is having a loan note of 368 million naira. So that in that case, it means that the beta of 1.8 is geared. So if the beta is geared, you need to ungear it. So to ungear, I told you there are 2 different formulas that you can use depending on whether or not debt beta is given. In this question, examiner did not give us debt beta. That means it is assumed that debt beta is risk-free. So if that debt beta is risk-free, then you use the singular formula. But if debt beta is given, you are going to use the extended formula. But in this case, debt beta is risk-free, so you know the formula to use. Then step 3 says you should gear to incorporate financial risk of Ferrari PLC because Ferrari is the main company. Again, you are not given the debt beta of Ferrari. That means it is also assumed to be risk-free. Then, of course, after you have regeared, you need to calculate cost of equity, which is step 4. You calculate cost of equity using capital asset pricing model. All right. So that is, then information to calculate capital asset pricing model are already given to us in the question. So we have no issue here. All right. So, and then step 5, you calculate project specific work. That's all. It's as straightforward as that. So without wasting more time, let's quickly solve this illustration. Okay. Let me stop this and then move to the working notes. Resume recording. Okay, so this is solution to illustration number, I think that's illustration number, let me check again. Number 6. So solution to illustration 6. That's page 47. Okay. So the name of the company is Ferrari PLC. Requirement number A. So we are asked to calculate project-specific cost of capital. Please, on the day of your exam, don't go and be writing PSCOC. You have to write it out in full, particularly in the first instance. because you don't want the examiner to be racking his or her brain what you mean by PSCOC. All right, so it's important that you write it out in full. So, step 1 says you should identify the proxy beta. I will then call me a proxy beta. According to the question, we have identified proxy beta to be 1.8. The beta of Costaris PSC is 1.8. Then step 2 says you should ungear to remove the financial risk of Costaris. Okay? And I said that we will only ungear if Costaris PLC has debt in its capital structure. Of course, when we check the balance sheet, Costaris has a loan notes of 368 million naira. So which means that this 1.8 beta is geared. So because it is geared, we need to ungear it to remove the financial risk embedded in the beta, because we want to calculate the beta that measures only business risk, and that's why you are removing the gear. You are removing the financial risk. Okay. So again, we have identified from the question that debt beta is risk-free because we are not given debt beta. So it means that it is risk-free. So to ungear, where debt beta is not given, you then say beta assets equal to beta equity of a gear multiplied by equity value of a proxy over equity value of a proxy plus debt value of a proxy, all multiplied by 1 minus tax rates. Okay, so this is the formula. I can either use this or I can say asset beta equal to beta equity of a gear. Let me rewrite that. Beta equity of a gear multiplied by 1 divided by 1 plus 1 minus tax, debt equity multiplied by debt equity proportion of the proxy. So whichever of the two formulas I use, I will still get the same answer. All right. But that notwithstanding, let's just use one and move on. Okay. I will then say beta assets equal to the beta equity of a gear that we have identified is 1.8 multiplied by, I need equity value and debt value of Costaris. I will then go to the question. Please open to the question at your end. Okay. So I want to calculate equity value and debt value of the proxy. So from the table given to you, you can see that we are given to calculate market value of equity. I need number of shares of the proxy company and the market price of the proxy company. So in the table given to us, we don't have number of shares, but we have share capital. Therefore, I need to divide the share capital by the nominal price to get number of shares. I will then multiply with the current market value per share of 3 naira. So it will give me the market value of equity. So the share capital of Costaris PSC is 500 million naira. The nominal price per share is 1 naira. So if that is the case, I will go and do working. This one will be for my project specific. Start with MPV. Okay, without going too far, so that we are not just switching from one page to another. So let's do working capital for market value of equity in this page. Let me see. This will be for the gear, capping, then work. So let's do the working here. We do working for the second part later on. So I want to calculate market value. Okay. So market value of equity value. Equity value is calculated as share capital, because we are not given number of shares, so share capital divided by nominal price. Multiplied by share price. Again, we are less concerned with whether dividend has been paid or whether interest has been paid. We don't have anything to do with dividend and interest here. For you to be looking for XD share price of whom X int price. So we don't need that one, all those ones here. All right. So for the cost, again, if I want to calculate debt value, so the debt value will be calculated. You can only calculate market value of debt if the debt has market price. If there's market value for the debt, then you can calculate market value. That is value per unit of the debt. In this case, we are given 102 naira for the loan note. So that means there is market price for it. So in this case, I will just say nominal value multiplied by market price. This market price is the same thing as what we normally call a X int price. So divided by 100 naira. That is always quoted at 100 naira per unit. So I will then calculate for Costaris. For Costaris PLC, debt value, sorry, start with equity value. Equity value will be calculated as the share capital of Costaris, according to the question, is 500 million naira. Current market price per share is 3 naira. So here is 500 million naira divided by 1 naira per share, multiplied by a share price of 3 naira. So this will give us 1,500,000. That is 1.5 million. So 1.5 billion rather. Then debt value, which is nominal value. I will then go to the question, what's the nominal value of the loan note? When you go back to the balance sheet, the information given to you, the loan note is 368 million naira, and the quoted market price is 102 naira per 100 naira. Okay, so here will be 368 million multiplied by market price divided by 100. Market price, we are told, is 102 naira divided by 100 naira per unit. Okay, when you multiply that, this will give us about rounding 375 million. Yes, Ufoma, what's your question?
Sir, good evening, sir.
Good evening.
Sir, if you're not giving the market value of debt, can we use the nominal value?
Of course not. If you are not given market price, that you will use book value. You use nominal value. Okay? So that means it's not traded. Okay? So now that we have calculated market value of equity and debt for Costaris PLC, I can then proceed to calculate to continue with what we are doing. So equity value, we have calculated 1.5 billion. So 1,500 figures are in million. So divided by 1,500 plus market value of the debt is 375. Tax rate, according to the question, I think we are told 20%. Yes. We are told that Ferrari and Costaris PLC both have tax rate of 20%. So if tax rate is 20%, that means we are supposed to account for 80%. 1 minus 20% is 80%. Okay? So with this, I can then get my beta assets. My asset beta will then be equal to 0.8. Okay, 0.8 multiplied by 375 equal plus 15. That's 1,800. All right, I would then say 1,500 divided by 1,800 equal, then multiply by 1.8 equal 1.5. So asset beta of Costaris is 1.5. Then I will move to step 3. Step 3 says you should regear in order to incorporate the financial risk of the main company. All right. In this question, the main company is Ferrari. Therefore, now that you have borrowed the beta, you have removed financial risk, then you have the beta that measures only business risk, which is asset beta. So in this case, we need to go ahead and incorporate, you need to regear to incorporate the financial risk of Ferrari, okay? Because your cost of capital must be consistent with the risk associated with the project. There are two types of risk that will affect the project, the business risk and the financial risk. Therefore, to calculate beta of a gear company, I will say beta equity of a gear equal to beta assets multiplied by 1 plus 1 minus tax multiplied by debt equity proportion of the main company, which is Ferrari. Okay. Again, I've already told you that since debt beta is not given to us, it is assumed to be risk-free, and that's why we are using this formula. If we are given debt beta, we would have used the extended formula that we used when we calculated project specific previously. All right. So I would then say beta equity of a gear equal to beta asset. We have calculated 1.5 multiplied by 1 plus 1 minus tax is 0.8. We have calculated that. Okay, we need to go and calculate debt equity proportion of Ferrari because Ferrari is the main company. So I would then say debt equity proportion for Ferrari. Equity value of Ferrari. According to the question, the share capital of Ferrari is what's that? Yes, 208 million. And then market price of Ferrari's share is 3.53 naira 50 kobo. So I would then say 208 million. Then nominal price per share is 50 kobo multiplied by 3.5. Okay. 416 multiplied by 3, let me see. Because when you divide 208 by 0.5, it will give you 416. Then multiply by 3.5. That's 1456. Here is 1456. 1456. Then debt value. I want to calculate market value of debt for Ferrari. According to the question, we are not given the Ferrari has bank loan. Pay attention. Ferrari has bank loan, 6% bank loan, 624 million. So since it's a bank loan, that means it's not tradable. So you cannot have market value for bank loan because it's not tradable in an organized financial market. Therefore, we can't calculate market value for bank loan. So I will just use the 364 like that. Sorry, 624. This one is bank loan. So we are given 624 million. When you add the two together, that will give us 2080. Yeah. So this represents total value. This is total value. I need that total value whenever we want to calculate our WACC. Okay. When we want to calculate the WACC, we are going to need it. Okay. So I will then come here. So the debt value of Ferrari is 624 divided by equity value of 1456. So we put it in our calculator. 624 divided by 1456 equal, then multiply by tax of 0.8 equal, multiply plus 1 equal, then multiply by 1.5 equal 2.01. Here is 2.01. So this represents the gear beta of Ferrari PLC. Yes, Charity, what's your question? Quickly. Charity, what's your question?
Good evening, sir.
Yeah,
It's on
talk to
the
me.
debt. I didn't know. I didn't get where you got the 2080. Please,
Is
can
there in
you
the
go back to
table?
it? It's not.
Is there in the table?
There is 208.
Are you sure?
There
The
is
share
208,
capital, the
but
share
there's no
capital, hold on.
2080.
Under Ferrari PLC, you will see 208 there, 208. Share capital,
Yes.
0.50 per share, 208.
Yes, but you wrote 2080.
Charity, exam has not come. You started seeing why. I wrote two, it's an addition of the two now. This plus this, that's what gave us 2080.
Okay, sir. Oh, thank God.
Okay, then let's move on. Is it clear now, Abi?
Yes, sir.
Okay, then. So we have re-geared and we got 2.01. The next thing we want, you can raise down your hand. You can put down your hand, Charity. So step
Okay,
4
sir.
now. Step 4 is to, so step 4 says we should calculate cost of equity. Okay, so I would then say calculate cost of equity using capping. All right. So cost of equity will be calculated as risk-free rate of return plus beta we calculated in step 3 multiplied by market return minus risk-free rate of return. Okay, I don't have enough space. I have to manage this. Let me divide this one into 2. So cost of equity would then be equal to, according to the question, we are given risk-free rate of return to be 3%. We're also given equity market risk premium. The difference between market return and the risk-free rate of return is equity risk premium, is market risk premium, so which is 6. Therefore, I would then say 3 plus, we calculated beta of 2.01 multiplied by the risk premium given to all is 6. Okay? Therefore, cost of equity will then be equal to, I will bring out my calculator to say 6 multiplied by 2.01 equal, then plus 3 equal 15.06. So cost of equity is 15.06%. Okay. Then finally, step 5 says we should calculate project specific WACC. Okay. So I would then say to get my WACC, so KW equal to, let me see if I can, I don't want to move after working. Let me just manage here. I do not estimate appropriate space or sufficient space. So WACC is equity value divided by equity plus debt multiplied by cost of equity plus debt value, equity plus debt, or multiplied by after tax cost of debt. We manage that space, little space. Okay, so WACC equal to, we have calculated equity value of Costaris to be 1456. Here is 1456. Total value is 2080. Cost of equity, we calculated 15.06% on the left, plus debt value for Ferrari Debt value is 624. Okay, 624 divided by total value of 2080, then multiply by after-tax cost of debt. I need to go back to the question. What is the cost of borrowing for Ferrari? According to the question in the table, we are told that we are given 6% bank loan of 624. Cost of borrowing is 6% for Ferrari. So here will be 6% multiplied by tax rate of 20%. 1 minus 20% is 80%, 0.80. Let me write that. The space I have there is short. Okay? 0.80. Therefore, let me just do it like this. Manage it. Then my work will then be equal to, from the left, I will say, bring out my calculator to say 15.06 multiplied by 1456 equal, then divided by 2080 equal 10.54. Here is 10.54%. Let me rewrite this one, make it bolder. Okay, then plus from the right, for the right hand side is 624 multiplied by 6 multiplied by 0.8 equal, then divided by 2080 equal 1.44, 1.44%. So when you add the two together, we have 11.98%. So WAP is approximately 12%. Okay? WAP is approximately 12%. So that's that. Oh, sorry. Okay, work is approximately 12%. So this is how to calculate project-specific work. We have done it before. I'm repeating it again. All right, so that's that. Then we move to number B part of the question. Where did you get 6%? Check the question, you see it in the table. I just mentioned it. All right, so let's go to the B part of the question. So in the B part of the question, who is doing poo in that place? Let me even see self. Emmanuel Okemen, mute. Chinonzo, all of you, please mute. Sanusi, everybody should mute, please. Sanusi, Yusuf, please. Okay, so number C part of the question, of the requirement. Sorry, number B, you have to assess whether Ferrari PLC should undertake the project of developing and commercializing the major component of outboard engine, assuming a discount rate of 12% has been applicable for the assessment irrespective of your calculation in A. Yes, examiner is asking you to use 12% as the cost of capital to evaluate the project because examiner is aware of the limitation of some students, all right? Because if you are to examiner, at times examiner can tell you to calculate cost of capital, then number B, they will now ask you to use the cost of capital you have calculated in step 1 to evaluate the project. So which means that if you get the cost of capital wrong, wrongly, if you calculate the cost of capital wrongly, that means whatever you are going to calculate in the B requirement, you are also going to be wrong because your cost of capital is not correct. All right. But examiner is aware of that limitation. That's why you are given 12% here, which is consistent with 12% we just calculated. Now, the bottom line here is that in this B requirement, you are to assess whether Ferrari PLC should undertake the project. What do you mean by assess? When I was explaining the concept, I told you that whenever examiner asks you to evaluate, right, or determine financial viability of a project or ascertain the financial viability of a project, or assess what that project should be undertaking. What the examiner is simply asking you to do is to calculate NPV. So, and I also told you that at all time, whenever you want to evaluate a project, it has to be NPV. Why? Because NPV is a technique that is consistent with the shareholders' wealth maximization objective. So as a result of the fact that NPV is consistent, all right, NPV is a consonant with the shareholders' equity value. So it's adjusted to be the overall investment appraisal technique, except examiner says otherwise. Unless examiner has you to use other method, it has to be NPV. All right. If examiner is silent, you are not told which method to use to evaluate a project. It has to be NPV. All right. So if that is the case, in this number B requirements, we want to calculate NPV. How do we do this? Very simple. I've already explained the concept to you, and I've given you formats that you can use. You are going to start your calculation on the basis of the format. All those items you have in the format are what you are going to follow. So without wasting more time on this, so let's quickly jump into calculating the NPV. All right. So number B requirements, calculating net present value. Let's restrict our number to millions. So this will save our time. All right. So also, don't go and be writing NPV on the day of your exam. At least for the first instance, you need to write it out in full. Net present value in brackets, NPV. All right. So again, I will go back to the question. Before I outline my table, I need to go back to the question to check the useful life of the project. What is the useful life of this project? Examiner has given us year 1 to 5. That means the useful life of the project is for 5 years. The useful life of the project is for 5 years. So if that is the case, I also need, before I put down anything, before I put my pen to paper, I also need to check from the question information on tax. How am I going to pay? How and when am I going to pay the tax? So according to the question, where do we have information on tax? Where do we have information? Okay, let me see. I think it's 20%. Yes. So we are told that it can be assumed that tax is payable in the same year as the profit on which it is charged. That means the profit of each year will be taxed in that same year. So this is not 1 year in arrears. So if that is the case, we are good to outline our table year 0 to 5. So I would then come here, year 0, year 1, year 2, year 3, year 4, and then year 5. I can introduce additional column for workings. Okay. So on the basis of our on the basis of our formats, the first item is sales. Therefore, we need to go and calculate sales. So this page will be for our NPV calculation. The second page will be for, I think we also have C part of the question where you have to state any relevant assumption made. All right. So if that is the case, yes. Okay, let's just start our working from here. So I will then come here working. So to start the working, I need to indicate the number of years first. So I have year 1 to 5, year 2, year 3, year 4, and then year 5. I will also indicate units for each year. What's the unit for year 1?
15,000.
15,000, okay.
40,000.
Year 2, 40,000,
100,000.
Okay, next.
120.
And then
190.
190,000. Okay, so working number 1 now. I want to calculate sales value. And you know, to calculate sales, what do? you are going to multiply selling price with the number of units sold. Before you multiply the selling price with units sold, you need to check from the question if you are given inflation rate. So according to this question, we are given inflation rate for selling price at 8%. So I will go back to the question, what is the selling price? Yeah, what's the selling price? Yes,
2,000.
2000. Examiner told you that it is estimated that in the first year, the selling price will be 2,000 naira per component. And then the inflation rate, we are told that thereafter, while the selling price is expected to increase by 8% per year. So inflation rate on selling price is 8%. Pay attention, please. Examiner has told you that it is estimated that in the first year, selling price will be 2,000. So examiner has given you first year price. You have been given first year price, which means that inflation should start from year 2. So I will come here, selling price at 8%. I'm not going to use primary school method. This is exam method. You are supposed to adopt. This one is faster. I can't be doing one by one, line by line. That one is a waste of time. You are still doing one by one. Your colleagues have moved to the next one. All right. So the first year price given to us for selling price is 2,000. If I were you, as you are there, I will bring out my calculator to follow through. All right. So if selling price is 2,000 naira in the first year, and I said that when you are given inflation, when you are given cash flow, if cash flow is stated in first year price, inflation should start from year 2. The fact that I said inflation should start from year 2 does not mean that your N will be equal to 2. N will still remain 1. However, you don't inflate the first year price because the first year price is the base year price. So I've explained this in the past when we had the question last week on Washington. I'm repeating it again. All right. So since inflation is at 8% and the selling price is the first year price, all I need to do is to bring out my calculation to say 1.08 multiplied by 2,000. This will give me 2,160. Whatever I have in my calculator, I will multiply with 1.08. This will give me 233. 2333. Whatever I have in my calculator, I will multiply with 1.08. This will give me 2519. And then the last one, what I have in my calculator multiplied by 1.08. This will give me 2721. Here is 2721. That's with this, I've inflated the selling price. Okay. I know some of you will still ask me, how did I get 2160? Let me just do the primary school to demonstrate only for this one as an example. So let me just, if I want to use primary school, all I need to do is to just repeat 2,000 across all the 5 years. You can't be doing this on the day of your exam. It's a waste of time. This is professional level, all right? You can't be working like like skills level students. All right, I would then say inflation at 8%. Because cash flow is stated in year 1 prices, I would then say 1.08 raised to power 0, 1.08 raised to power 1, 1.08 raised to power 2, 1.08 raised to power 3, 1.08 raised to power 4. Okay? I will still get the same answer. It's the same answer I will get. So here will be anything raised to power 0 is equal to 1. So 1 multiplied by 2,000 will still give me the same 2,000. This one will give me 2160. This will give me 2333. This one will give me 2519. And this one will give me 2721. So whether you use primary school or you use the other method, so you're still going to get the same answer. All right. So, but you can see I have only 1 line item in my preferred approach. Here there are 3 line items. It's a waste of time. Okay. Again, if the second one is most appropriate for you, if you are more convenient or comfortable with this approach, so be it. All right. So this one will number B. To now get the total sales, our figures are in million. So I will say A multiplied by B. So 15 multiplied by 20,000 multiplied by 2,000. What do you have there? 15,000 multiplied by 2,000.
30 million.
That's 30 million. Our figures are in million. I'll put 30 here. The next one, what do you have?
86.4.
86.4. 86.4. Rounding to 87. Let's round it to 87. So
The point
86.4, that's 86.
That's correct.
Next one. This one will be 233. Right?
Yes.
Sir. Yes,
Okay,
sir.
next one.
302.
302 million.
516. 517 now.
517. With this, we have calculated our sales. All right, we have calculated our sales. So if that is the case, I will then go and post 3086. Okay, year one is 3086. I know this one to be 517. This one is 302. Then year three is what?
233.
233, yeah. 233. So with this, we have calculated our sales. I will then go ahead again and calculate variable cost the same way like calculated sales. Working number 2, variable cost. So variable cost, inflation rate on variable cost is how much? The same place we have selling price.
5%.
5% is inflation rate on variable cost. So I will say at 5%. So variable cost in the first year we are told is 800 naira, right? Okay,
Correct, sir.
800. So I would then say 1.05, 1.05 multiplied by 800 equal 840. 840 you have in your calculator multiplied by 1.05.
874.
882. This is 882. So whatever you have in your calculator, multiply by 1.05.
926.
That's 926. What you have in your calculator, multiply by 1.05. That's
972.
972. Okay, so let's say this is C. Then total variable cost in million equal to A multiplied by C. Okay, so 15,000 multiplied by 800.
12.
That will give us 12 million. Next, 40,000 multiplied by
34.
34, right?
Yes, sir.
Yes, 34.
Next one, 100,000 multiplied by 882. This will give us 88.
88.
Okay. Next one, 120,000 multiplied by 926.
111.
111.
Yes, sir.
Then 190 multiplied by 972.
185.
185. That's our variable cost. So let's go and post. So variable cost for year one is 12 million. It's a cash outflow. Year two is 34. Year three is what again?
88.
Yes, 88. Year 4,
111.
111.
triple 1. Year 5,
185.
185 million. So that's working number 2. Then I will go back to the question to go and identify any other relevant cash flows. Okay, still on the same paragraph. You are told that, what is that again? Yes, you are told that, and total direct fixed cost will be 6 million naira. You are given direct fixed cost. You know, when I was explaining the concept, I told you that when you are given direct fixed cost, incremental fixed cost, attributable fixed cost, or specific fixed cost, they are all relevant and should be considered. So examiner was telling you here that the fixed cost of 6 million naira is a direct fixed cost, which means it is relevant. And then what was the inflation rate on fixed costs? We are given 5%. Therefore, in this case, I don't need to do any working for my fixed cost. So I will just come here, direct fixed cost at 5%. I don't need to be wasting my time on the day of the exam because time is, every second is important to you. So the first year price given to us is 6 million. All right. I will then say 6 million. Inflation rate is 5%, 1.05 multiplied by 6. So that will give me 6.3. Here will be 6.3. Okay. Whatever you have in your calculator, multiply by 1.05.
7.
This will give us a 7 or 6.6. You can say 7.
And
All
6.
right. That's 6.6 something, that's 7. So since we are rounding our number to whole number, so let's put 6 there. Then in year 4,
7.
7, then year 5.
7.
7.
Okay, so that's it. If you want to do working for that, no problem, you still get the same answer. Just apply the same concept. Then I will go back to the question in case I have other relevant cash flows. Okay. Yes, still on the same paragraph. Okay, we are told that, no, not that paragraph. Yes, we also have, according to the question, still on that same paragraph where you have the fixed cost, you are told that training and development costs are expected to be 120% of variable costs in the first year, 40% in the second year, and 10% in each of the following 3 years. So we are told in the question that when you go to the second paragraph of the question, examiner has already told you that there will be a considerable training and development cost in the first 2 years. Okay, the research study have also found that in the first 2 years, that is the development phase, there will be considerable training and development costs. So training and development cost is a future cost, according to the question. An examiner has already told you that the training and development costs that you should account for 120%. Training and development costs are expected to be 120% of variable costs in the first year, 40% in the second year, and 10% in each of the following 3 years. So if that is the case, I need to go and do working for my training and development costs. So working number 3, training and development. First thing first, I need to write out the percentage. So I will say T and D, training and development percentage on variable cost. We are told that in the first year, it will be 120%. In the second year, it will be 40%. In the third year and the subsequently, it will be 10% each. Okay, so these are the percentages on variable cost. Therefore, T and D, trading and development on variable cost. So 120% of 12, because training and development cost is 12 for the first year. So 120% of 12 will give us 14.4.
14.
So I will say 14 since we are rounding our number to whole number. I think examiner also mentioned in our calculation that all figures should be rounded to whole number. Let me check. No, not this question. Not in this question. Okay, then. Oh, yeah, let's move on. So 40% of 34 is what?
14.
14. Okay. 10% of 88 will give us 9. 8.8 is 9.
Yes, sir.
10% of 111 will give us 11.
11.
Then 10% of 185 will give us 19.
19.
Okay, so with this, we have calculated our training and development, 14, 14, 9. So let's go and post. Training and development. 14, 14, then 9,
9, 11.
11,
19.
then, and then 19. Dash. Okay. Then, of course, let's go back to the question. When the lady was reading it, I made some comments on, yes. In the first paragraph, examiner has told you that for this purpose, the company has recently purchased the patent right for 15 million naira to produce the components. So you have patent right of 15 million naira. That 15 million naira is irrelevant because it's a sunk cost. The patent right has already been incurred. The patent right cost of 15 million naira has already been incurred. Therefore, remember, cash flow must relate to the future. So that 15 million naira is a sunk cost, not relevant. In addition to that, we're also told in the second paragraph that Ferrari PLC has spent 20 million naira developing prototype of the component and undertaking market studies. So that 20 million naira is also a sunk cost, it's a past cost, therefore not relevant to the calculation. So when you are stating your assumptions, you need to talk about all of that. In fact, any calculation you are doing, whether examiner asks you or not, whenever you are evaluating a project, it's expected that you must state your assumption. You just have to. Whether examiner asks you or not, you have to do it. All right? So we're also given working capital in the question. So we are going to treat working capital later on. Remember, we are following a format. Okay, so at this stage, I need to determine profits. So let's add it up. All right, so let's pick it one by one. Let me do for year one. 30 minus 12 minus 20. That's minus 2. Here is minus 2. That's a loss. So here is profit or loss. Yes?
Year 2, 31.
31. Let me do for year 5 again.
Year 5,
517
306.
306. All right.
4, 173.
177.
No,
Year 3,
173.
129.
178 year 4.
No,
Yes,
no,
year
no, 173.
173.
Yes, sir.
Okay. Then year 3.
129.
129. Okay. So this is working number 3 here.
Year 2 is
So
32.
year 2 is, yes,
32.
yes, it has to be 32. It's true. 20 plus 34. Yeah. This is 32. Okay, then. So these are profit or loss. So the next thing we need to do is to pay tax. The company tax rate is 20%. Yes, before we do that, Ufoma, you raise and talk to me quickly.
So this training and development course, I thought is a irrelevant course if it's not stated.
Why do you think it's an irrelevant cost? Oh, yeah, now. Ufoma, why do you think it's an irrelevant cost?
Because it's not attributable to the project, I think so.
Is that what the examiner told you? Even when I've already read it for you. You are told in the second paragraph that the research study have also found that in the first 2 years, that is the development phase, there will be a considerable training and development cost. There will be a considerable training and development cost. It's a future cost. They have not incurred it. So it's very clear in the question. All right. So it's
Okay, sir.
irrelevant.
Thank you.
It is relevant. Yes, Minister of Finance, what's your
Yes,
question?
sir. The patent right. The
Yes.
examiner said for this purpose,
Yeah.
the company has recently. So is it because of the word recently now that we are treating it as sunk cost?
It's a past cost now. Can you see the purchase you have there is it not the past tense?
Okay, because I was thinking since it's for the project.
That's not the issue. That's not the basis. You can see the past the patent rights has already been incurred. It's a past cost. Recently, the company has recently purchased. When you buy something, like yes, you buy something yesterday. Yesterday is you can also say yesterday is recent, isn't it? If you buy it a week ago, a month ago, it's still recent, right? So you bought something in the past. You can't use it for future decision that is to be taken now. It's a sunk cost. All right.
Okay, sir.
Okay. So I want to determine tax liability. Like I explained to you when we were discussing the concept, I can either use capital allowance to reduce my tax liability, or I use tax saved on capital allowance to reduce my tax liability. In the format I gave to you, that format is structured on the basis of using tax saved on capital allowance to reduce tax liability. So if that is the case, I need to determine tax liability in this. If I want to use capital allowance, I will bring out all the profit I have. I will go and calculate my tax liability separate. All right. I will bring out the profits. I will deduct capital allowance. I will have taxable profit. I will then apply company tax rate on it to get my tax liability. But I don't want to follow that route. All right. I'm using tax saved on capital allowance. To use tax saved on capital allowance, all I need to do is to just multiply the company tax rate on the taxable profits. Now, pay attention here. In any year a company makes loss, you don't pay tax on loss. You have to move to the following year where the company has made profits. Like in this case, if there is no further information, if there's no additional information in the question that relate to loss relief, I will just ignore year one. I will move to year two, profit of 32. I will apply 20% on that 32. But because in this question, the examiner has told you that the company makes profits. Let me go back to the question. When the lady was reading it, I was underlining it. Yes, if you go to the paragraph after the table for units, after the table for number of units, examiner told you that where you have the scrap value of 160 million. Now, examiner told you that the company makes sufficient profits from its other activity to take advantage of any tax loss relief available from this project. So there is a loss relief available from other business activity, which means that in the year the company has incurred loss, like in this case now, year one, there's a loss of 2 million. You are not paying tax on that loss. You want to relieve your loss. To do this, I will multiply 20% of the 2 million naira loss. So that will give me 4. Okay. 20% on this will give me 0.4. Here will be 0.4. This 10.4 is, you are not going to put it in bracket, because if you put it in brackets, that means your loss will be increasing. It means that you are paying tax on loss, which is not true. So you are relieving your loss. It's a loss relief. So this will, by the time you add these two together, 2 million, when you had 2 million plus this 0.4 positive, so to reduce, that means your loss has reduced to 1.6. Okay, so That is for that. That's how you are going to treat it. The only reason why you treat it this way is because of the fact that in the question, the examiner has told you that the company makes profit from other business activity from which to take advantage any tax loss relief. All right. So because there's loss relief, that's why we have to multiply company tax rate on the loss of 2 million in year one. Okay. So that is for that. Then I will then calculate tax liability for year two profit. Year two profit is 32. Okay. 32 multiplied by 0.2 equal 6.4. So here will be 6. So tax liability, put it in brackets. And we have also identified from the question that company is paying tax in the year profit is earned. So year three profit is 129 multiplied by 0.2. That's 25.8, rounding 26. Then in year four,
35.
170, pardon?
35.
35, that's 34.6, 35.
61.
61 for year five. Okay.
That's still question about this loss. Like,
What's your question?
why are we treating it this way? Like, I thought we would have taken it to the second year and minus the 2 inside. Then we would have
Minister of
calculate.
Finance, you are not paying attention to what I've been saying since.
No, I'm listening. Just that I was
If
thinking that was what we're
if
going
you
to
are
do.
listening, you won't be asking me that question again. I went to the question, I read it to you. I told you why we are treating it the way we are doing it. Examiner has told you in the question that when you go to the paragraph, after the number of units where you have units produced and sold, in that paragraph, the last statement in that paragraph, examiner told you that the company makes sufficient profits from its other activities to take advantage of any tax loss relief available from this project. There is a loss relief from other business activity to take advantage on this project. So, and I also, before I said that to you, I told you that if there is no further information in the question, anytime, whenever you make loss in a particular year, you don't pay tax on loss because that will be double jeopardy. And I told you that you just put a dash, move to the following year where there is profit. But in this question, examiner has already told you that the company may profit from other business activity from which to take advantage of any tax loss relief. So because of that, that's why we are calculating, we are relieving the loss on this 2 million naira. We are relieving it. That's why we multiply 20% on 2. All right, it's a recovery. I hope it's clear now, Minister of Finance.
Thank you, sir.
All right. So after tax liability, the next thing we are going to do is to calculate tax saved on capital allowance. So I will then say tax saved. So let's go and do working for tax saved, working number 4. Okay, I will come here. Tax saved on capital allowance. Okay. If I want to use primary school method, I will just come here, indicate column for year. All right, narration, the cost of the assets, then tax saved. This is the format I gave to you. Tax saved. Company tax rate is 20%, so at 20%. Our figures are in million. Okay. So in year 0, we have the cost of the asset. I will then go back to the question. Machinery costing 480 million naira. The cost of the machinery is 480 million. So I will come here, 480. Figures are in million. In year 1, we claim capital allowance. All right. We are not given initial allowance. We are only given annual allowance of, let's go and check. Where's do you have? Yes, still on that
10%.
same paragraph. Tax allowable to depreciation is available on the machinery at 10% on a straight line basis. Okay, scrap value is 160 million. So 10%. So I will say at 10%. on a straight line. 10% of 480 will give us 48. So 48 minus 480 minus 48 will give us 432. So this represents tax written down value at the end of year 1. I will move to year 2. Annual allowance is still the same thing as 48 because we are told on a straight line basis. When you deduct, that will give us 3 words.
84.
384. All right. Then year 3, annual allowance 48.
336.
336. Then, of course, tax written down value. In year, remember, the useful life of this project is 5 years. So, in year 4, annual allowance 48 minus 336.
288.
288. This is tax written down value at the end of year 4. Now, the final year is year 5. So I need to compare the tax written down value from the preceding year with the sales proceed, whether it will result in balancing allowance or balancing charge. So I will then come here sales proceed. According to the question, we are told that this machinery will be disposed of at 160 million. So this will give me 128 million. So this represents balancing allowance. At the end of year 5. Okay, so I need to multiply 20% on the tax saved. I need to multiply 20% on the tax saved. All right, so on the capital allowance, 20% of 48 will give us 9.6.
10.
When you round up 9.6, that will give us 10. 10, 10. Okay, this one also 10. Now, 20% of 25.8. What do you have? Yes. 20% of 128.
26.
26. 26. So here will be 26. Again, before I conclude on this, I need to confirm that I have not claimed beyond or above the capital allowance I'm supposed to claim. The total capital allowance claimable, total tax saved, is calculated as capital allowance minus scrap value multiplied by company tax rate. I cannot claim beyond what I'm supposed to claim. Whatever total tax save I'm supposed to calculate, or I'm supposed to claim, cannot be more than this. The cost of the asset is 480. Scrap value is 160. Company tax rate is 20%. So what do you have here?
64.
64 million. So total tax save I'm supposed to claim is 64 million. So when I add up all of this is 66, which is more than, because we have rounded this to 10, 10, 10, 10. That's why it's 66. If you have done 9.6, okay, if you have done 9.6, so we cannot claim more than what we are supposed to claim. Oh, okay. I was thinking maybe my markers, but my pen is not connected again. So here is 9.6. 9.6 that we got. 9.6. 9.6.
Is correct.
Then this one is 25 point what?
0.6.
25.6. So when you now add everything together, it will give you that 64.
64.
Because we cannot claim beyond what we are supposed to claim. Okay. So here is 64. This is total tax saved. TTS. So the essence of this one is just to confirm that you have not claimed beyond what you are supposed to claim. It has nothing to do with your calculation. It's just to confirm that. So let's go and post it. 9.6. Okay. Again, your tax saved on capital allowance must follow the pattern of your tax liability. If your tax liability is in the current year, your tax saved on capital allowance must be in the current year. If your tax liability is in 1 year in arrears, then your capital allowance must also be 1 year in arrears. Okay? So here is 9.6. 9.6 is a claim, 9.6. Then here is 25.6. Is this 25.6? I think so. Yes, 25.6. That's it. Okay, so the next item will be scrap value. We have a sales proceeds of 160 million in the final year, year 5, 160 million. Then we have initial outlay. Remember, we are using the format. Initial outlay is 480 million. It's a cash outflow. Then we also have working capital in the question. So we need to go and calculate working capital. All right. That will be working number 5. Working number 5. Working capital. Okay. For year 1, year 2, year 3. Let me adjust. Year 1, 2, 3, 4, and 5, and then total. So I will go back to the question. How are we going to treat our working capital? Is our working capital a one-off or incremental working capital? Certainly, examiner will tell you. When you go to the paragraph after the paragraph where you have the machinery, the cost of the machinery, you are told that initially, Ferrari PLC will require additional working capital for the project of 20% of the first year sales revenue. Thereafter, every 1 naira increase in sales revenue will require a 10% increase in working capital. So, examiner has told you that there's a working capital of 20% on the first year sales. After year 1, any 1 naira increase in sales value, then the company the company will require 10% working capital. So if that is the case, let's interpret it. Okay, first thing you need to do is to determine incremental sales. Since the examiner has told you that for every 1 naira increase in sales revenue, the company will incur a working capital of 10%. Therefore, you need to determine your incremental sales first. So I will then come here, incremental sales. The sales of year 1. The sales of year 1 based on our workings. The sales of year 1 based on our working, I think is
30 million.
30 million. Okay. Here is 30 million in year 1. 30 million has increased to 86 by 56. Again, 86 million in the second year has increased to 233 in the third year. Therefore, what's the increment? 233 minus 86. That's 147 increase. That's an increase of 147. Also, from year 3 to year 4, sales has increased from 233 to 302. By what difference? 302
69.
minus 233. You said it's 60, yes, 69. Okay. So increment is 69 in year 4. After that,
215.
again in year 5. Pardon?
215.
215. So These are the increments in sales. These are the increments in sales. This is not working capital. They are just increments in sales. So examiner now told you that, of course, I would then say working capital percentage on sales. Again, on the day of your exam, you don't need to be doing all this line by line. It's a waste of time. You can see the percentage in the question. Examiner has told you that in the first year, working capital will be 20%. For every ₦1 increase in sales revenue, the company will incur working capital of 10%. All right, so here is 10%. What I'm saying is that on the day of your exam, no need to be doing all these 10%, 20%. You already have that percentage in the question. Just apply the percentage on the sales and on the increment and move on straight, because you don't have the luxury of time to be gallivanting here and there and be wasting time on the dressing your notes. You don't need all those ones. All right, go straight to the point and move on, so that the earlier you finish the question, the better for you. You move to the next question quickly. All right, so here will then be incremental working capital. Okay, the next stage will then be incremental working capital. So 20% of 30 will give us 6. Okay, then 10% of 5.6 will give us 6 also. 10% of 147 will give us 15, I think. Yes, 10% of 69 will give us 7, rounding. 10% of 215 will give us 22. Therefore, all I need to do now is to add up everything together. 6 plus 6 will give me 12. 12 plus 22 will give us 34. 34 plus 22 will give us 56. So here will be 56. All right, let me confirm again. 12 plus 15, that's 27, 34. Yes, 56. I think I'm correct. So the rule says that working capital should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. All right. The total working capital is 56. All right, is 56. Therefore, the one that occur at the end of year 1 should be treated as cash outflow in year 0, because year before year 1 is year 0. The one that occur in year 2 will be treated as cash outflow in year 1. The one that occur in year 3 will be treated as cash outflow in year 2. The one that occur at the end of year 4 will be treated as cash outflow in year 3. The one that occur at the end of year 5 will be treated as cash outflow in year 4. Then at the end of the useful life, you recover the entire working capital. So this is how to treat. Like I explained to you when I was giving you the notes, all right? There's no specific way you are supposed to treat your working capital. The scenario of the question will always be different. All right, you can see the working capital we treated under the question of Washington PLC last week is different from the way we are solving this. So examiner will always make it to be different from however the question has come. You have the bottom line is for you to ascertain whether it's a one-off working capital or incremental working capital. The treatment will still remain the same, but the only thing is that the scenario, how the working capital will come to you may differ, all right? But you have responsibility to be able to identify how you are going to treat it, whether it's a one-off or incremental. If it is incremental, what is the instruction from the question? Then you apply it, all right? So with this, let's go and post, please. See, I was making out today that I'm going to solve like 4. You can see, 2 illustrations. We are still on 1 question since we have not completed it. Okay. Oh yeah, let's move on. So I have 6, 6, 15, 7. 6, 6, 15, 7. So year 0 is 6, 6, 15, 7. Then
22.
what did you say?
22.
22, then 56.
Yes.
That's working over 5. Okay, so at this point, I need to determine the net cash flow. Here is 486. So add up everything for each year. What do you have for me? Okay, that one is 10. 10 minus 8. This one will be 2. Okay. 32. 32 minus 6 plus 9.6 minus 15. 20.6, rounding 21. Then 129. 129 minus 26 plus 9.6 minus 7. That's 105.6. That's 106 rounding. 173. 173 minus 35 plus 9.6. Okay, minus 22. That's 125.6, 126. And the last one,
487.
487. Thank you. Okay, so at this point, I can use any technique to evaluate the project. From this net cash flow, I can use any technique, including payback period, NPV, discounted payback period. I can use internal rate of return, modify internal rate of return, project duration. The only technique I cannot use is accounting rate of return because you need accounting profit. So I will just come here, discount factor. Okay, because of space, let me put DF. So examiner has told us in the question that we should assume 12%. Is it 12 or 13? I think it's 12. Yes, 12%. Therefore, I need to get discount rates for year one at 12%. So 1.12 raised to power 1 minus, that's 8.93, 0.893. Then in year two, 1.12 raised to power 2 minus 0.797. So in year three,
0.712.
0.712. Year four,
0.636.
636. Year five,
0.567.
0.567. Okay. So the next thing I need to do now is to get my present value. So I'll just multiply to get the present value. There is 486. Okay. So for year two, 2 multiplied by 0.893. So I have 1.786. So rounding 2, right? Rounding is 2. Then 21 multiplied by 0.797. That's 16
Rounding
points.
17.
That's 17. Rounding to 17. Then 106 multiplied by 0.712.
75.
75. 126 multiplied by 0.636.
80.
80. The last one.
276.
276. 276. So this represents the present value. So I need to get the NPV. We said that net present value represents the difference between the present value of cash inflow and present value of cash outflow. I will add up the positive present value. I will net off 486. What do you have there?
Minus 36.
Minus 36. Minus 36. That means the project is not financially viable. Okay. So I will then come here. So that's end of that. I will go back to the question. In the requirement number B, examiner is only asking you to assess whether the company should undertake. In this case, we need to advise. All right, we need to advise. So I will then come here. Since the project produced a negative NPV, that means it's not financially viable. So I will then say the project to develop and commercialize, the project to develop and commercialize the major component of outboard engine. The major components of outboard engine. It's not financially viable. It's not financially viable. Considering the negative NPV. Negative NPV of 36 million naira. Okay, let's put it this way. The negative NPV of approximately 36 million naira. Okay. Therefore, the projects should not be undertaken. The project should not be undertaken. So that's that. Finally, in the C part of the question, examiner is asking you to state assumptions. So I will come here, number C. Assumptions. Like I said earlier, whether examiner asks you or not, it's your responsibility. Whenever you have done calculation like this, you have to state your relevant assumptions. Even though in the question, in the C part, you have to state any 3 relevant assumptions made for your calculation in A and B above, 3 marks. Okay? So if examiner did not tell you, it's something you must do. All right? So, and I've already told you anytime you want to state your assumption, all right, you have to start from, of course, anytime you evaluate a project, certainly you are going to have cash flow, okay? Number 2, you're also going to have cost of capital. If you have inflation in the question, you talk about inflation. Any other assumptions you have made, then we follow. So in this case, our assumption on cash flow is that I would then say the cash flow estimates, the cash flow estimates, okay, the cash flow estimates are assumed to be realistic. To be realistic and occur at the end of each year. At the end of each year. Or if I want to add more, I can say all relevant cash flows. All relevant cash flows have been inflated at the appropriate inflation rate. Inflation at the appropriate inflation rate. All right, so that's our assumption on cash flow. Then again, like I said, in the question, we are given cost of capital of 12%. So we need to, what's our assumption on that? So I will say cost of capital. So it is assumed that the cost of capital of 12% given is appropriate. And consistent with the cash flow and project risk. Okay. Money cost of capital for money cash flow. All right. So the cost of capital to be used for a project must be consistent with the risk associated with the project. So our assumption is that this cost of capital of 12% given to us is consistent with the risk associated with this project. Then number 3, we are given inflation in the question, so we need to talk about inflation. Okay. So I would then say the specific inflation rates. The specific inflation rates are assumed to remain constant within the relevant range. Relevant range. Okay, that's our assumption of inflation rates. It means that all those inflation given to us, 8%, they are specific. 8% for selling price, 5% for variable and fixed costs. They are specific inflation. So our assumption is that they will remain constant. They will not change, all right, within the period under consideration. Then number 4, in the question, let's go back to the question. We also have some costs. We are given patent rights. We're also given development costs. I would then say the patent rights, the cost of patent rights, the cost of patent rights of 15 million naira and developments cost of 20 million naira are past costs. Are past costs. Therefore, not relevant to the calculation. Okay. Calculation. So that's our assumption on those items. Then, examiner, these are the assumptions we made on requirement number 2. in the requirement number 1. Let's add one more to this. Examiner says should stay 3. So in the requirement number 1, we are not given debt beta in the question, which means that debt beta is assumed to be risk-free. So I can come here, I will say debt beta. Okay, so since debt beta is not given in the question, it is assumed to be risk-free. Okay, it's assumed to be risk-free. If you want to add one more, we can talk about business risk. What do I mean by business risk? Our assumption is that the proxy company, okay, it is assumed that both Costaris is the proxy company, both Costaris PLC and Ferrari PLC have similar business risk, have similar business risk. That's why we are borrowing the beta. That's why Ferrari is borrowing the beta of Costaris. Okay. So these are some of the assumptions that we made in the question. If you want to add one more, we can talk about debt equity proportion, that it is assumed that the debt equity proportion of the proxy company and that, we already know the proxy company. So you can say that it is assumed that the debt equity proportion of Ferrari and then Costaris PLC will not change, okay? We have calculated market value for Ferrari to be 1456. Market value of debt of Ferrari to be 624. Our assumption is that that proportion will not change, to remain the same, to remain constant. The same thing as the, what's the name again? Costaris PLC. So we calculated market value of Costaris PLC equity value to be 1,500. Debt value of Costaris to be 337. Our assumption is that they will remain constant, to not change. So the gearing ratio will remain constant. All right. So this is end of the question. This is end of the question. Let me go back to the comment section to hear some people are sending messages. What page is this? I want to believe, Omawumi, you came late. All right, somebody has already answered you. Okay. So you are a bit faster, really? Okay. I believe you are able to catch up thereafter, Charity. Then somebody is asking, uh, oh, OADZ Consulting. Sir, please, the assumption, I didn't see the number 1. Please, can you scroll up? You know that we always share the material at the end of the class, so you can see it from there. But in any case, this is number 1. Yes, Ufoma, what's your question, please? Talk to me.
Hello, sir. Is on this working capital, I was thinking that is incremental working capital. I don't know, is it because that the sales has been increased? That's why we do not do the incremental.
Yes, now, the working capital we calculated is incremental already. Because you have increased your sales, you are only taking the incremental sales. If you have taken incremental sales, that means you have also calculated incremental working capital. All right, Ufoma. So
Okay, sir.
your assumption, what you think is correct, because we've already calculated incremental sales. That means whatever working capital you get is also incremental working capital. All right?
Okay, sir.
Good.
Thank you.
You are welcome. So, yes, that is end of the question. You can see it takes time. Even when you are the only one solving this on the day of your exam, certainly a compulsory question like this can throw you off balance. And just have to keep calm. Don't panic. Just solve the question the way you understand it. The first thing you need to do is to take a very deep breath. All right, take a very deep breath. So that will allay your fear. Then read the scenario. Before you begin to read the scenario, go to the requirements to identify or to check what the examiner is asking you to do. Once you understand the requirements, then you need to think about, okay, this is the requirement. What am I supposed to do? You need to, at that point in time, you need to articulate your points. How do you approach the solution? How do you solve the question? All right. How do I present my work? All right. But for you to be able to do all of these things that I'm saying, you need to practice as many questions as possible. You need to expose yourself to different scenario questions. Once you do that, that will build your confidence. In fact, once you have attempted as many questions as possible, it will be you. In fact, you'll be calling on ICAN that you will want ICAN to come and test you now because you are ready. But if you are not reading, you are not studying on time, you are waiting for the last minute for you to begin to do crashing. Crash studying doesn't work. If it work for you, it's just by chance, it's just by accident. All right. Nobody prepare for professional exam relying on crash studying. A month to the exam, you then begin to read. It doesn't work that way because you are not computer. Even those that have been reading from day one, they are still struggling to cover the syllabus, let alone somebody that is, oh, because I'm busy, because of you are just looking for excuses. You are not busy, you are not busier than some people. Yes, they find way to excel. So you have no excuse. This is professional, this is final stage. Whatever it will take you for you to achieve excellence, you just have to do it. Time is going, your money is counting. For those of you that have paid for the exam, you have paid for lecture, you have paid for the exam. In your places of work or at home, people are aware, your colleagues are aware that you are writing a ICAN exam come November. What are you going to tell them in December when your result is released? I've already told you when we started this. So you need to make that your effort counts. Look at you, look at time. You are still in the class. So you need to read. You need to read, you need to gain, you need to get value for that money you are paying. All the efforts that you are making every day and night, you need to make it count. But if you don't study, how will you be able to? If I ask some of you now, some of those questions that we have solved in the past, if I ask you to solve it and share it with me immediately, because you have not studied it, you may struggle. And that's why you have to change your mindset. We are done with 50% of the diet lectures because we are now in September. We have this month of September and October to prepare you for the exam. So if you have not started reading, you are not helping yourself. A whole lot is at stake. You don't want to make ICAN a going concern. You need to stop. You need to end your ICAN journey this year. You have to qualify this year. This is your year to qualify. So what I'm now telling you in essence is that if you have not started reading, you have to start almost immediately now. You have to start now, start reading now. Develop your reading timetable. Don't read randomly. Because if you are reading anyhow, you are going to get anyhow results. You have to structure your reading Monday to Sunday, minimum of 2 hours per day. If you have not started reading at all, you need to increase it to 3 hours per day. So if you are sleeping for 5 hours every night, you have to reduce it to 4 hours so that you can maximize the little time that you have. I know it's challenging because some of you are working. That's not an excuse. Okay? It's not because you are not the only one working. All right? So you just have to find a way to excel in your exam. That's the bottom line. God Almighty will make it easy for you. So let's have one more. Okay, somebody is sending a question. So I'm scaring you. Charity, scaring you how? I'm telling you the reality. It's just for you to seek redress. So you just have to readjust yourself. Be bold, be confident. Be confident that this exam I want to write is once and for all. That confidence will not come from anywhere. Confidence comes from experience. For you to gain experience, you need to practice as many questions as possible to boost your confidence, going to the exam hall. You don't go to the exam hall with any reading material or study material or whatever. You are going there with your written material, your calculator, your mathematical set. That's all. You don't go to the exam hall and be carrying textbook, strategic financial management, golden book by Adejuwon, so that people will know that you are reading. No, you don't go to the exam hall with any reading material. Just go there with your calculator alone and the mathematical set and be bouncing. You just be looking at others that are reading, that just was so you don't need all of that because you've already prepared yourself ahead of time. You don't wait for the last minute because we are human. All right, we are human. The way we are structured, the way God created us, we are different from machine. Machine is garbage in, garbage out. Whatever you put into the machine is what you are going to get. But we are human. At times, when you read something today now, give yourself like 3 days or maximum 1 week. That thing has disappeared. You have to start only. You'll be scrapping. But I read this thing a few days ago. I can't remember. You want to define something. You not be struggling to define something you have read and understood. You not be struggling to recollect. And you are not the only one in that shoe. It's everybody. So you have to devise means to ensure that that thing remains there. So you need to do it over and over again for the thing to store in your memory. But if you don't start reading on time, you are going to struggle. That's my point. We've been saying this from day one, and some of you have not changed. It's still the same you. You don't read. Some of you don't even attend classes. Yes, some of you don't attend because I know how many of you are in that group. How many of you are attending classes tonight? It has been consistently. I can mention those people that are frequent in my class. So that's what we are saying. Even the video that you have access to watch, some of you don't watch it. You are waiting for the last minute. It doesn't work that way. If you truly want to achieve excellence in this exam that you want to write, you need to change your mindset. You need to develop that growth mindset that will enhance your performance on that day. If some people are telling you the exam is difficult, don't allow that to derail you, to make you lose focus. Tell yourself that where others are failing, you want to succeed. Yeah, because we are different people with different background, with different exposure. We are different people with different level of assimilation. All right? The way we read and understand things differ. So don't listen to any negative thing that some people are telling you. Ignore whatever they are saying. Focus on what you want to achieve. Because I've already told you, ab initio, that the result of this November diet will be released few days to Christmas. So you need to make it a double joy. Yes. Who says you cannot achieve that? If I can do it, you can do it. If others can become chartered accountant, you too can become it. That's why ICAN is saying, if I can, you can. So your result of this November diet exam will be released few days to Christmas is on the 25th. Either between 21 to 23, your result will be released. So if you want to make it a double joy, you need to start planning, you need to start working now so that when your result is released and it is positive, oh God, I thank you. You gather people together to celebrate your qualification. But if otherwise, you will not be happy all throughout that Christmas period, even including the new year, because anytime you remember that you failed, of course, your mood will change. People will be asking you what happened, but you are the one that know what happened to you. So guys, you still have time. You still have time. You have about 78 days now to the D-Day. Yes. You have 78. In fact, it has reduced to, because today is almost gone, it has reduced to 77 point something days. So you can see, you don't have time. Your exam is starting November 18th. All right. Your exam is starting November 18th. So if you still have time. You still have time, 78 days to the D-Day. So change your mindset. Be dutiful. Show more hard work. All right. So if you are serious, if you are focused, if you are determined, if you are committed to this course, certainly you are going to do well on that day. I've never seen anybody that is so committed to studying and fail that paper. If you do, maybe because of one or two mistakes you have made, it's very rare. There's even yourself, you will love what you have gained if you study very hard and study smartly. And not only that, you rely heavily on God Almighty. Certainly, you are going to achieve excellence. So, guys, please change your mindset. Change your mindset and start developing that growth mindset now. Start developing it. You need it for you to excel. God will make it easy for you. So sorry for that little time that I take.
Thank
So
you, sir.
let's see, because again, I have two more illustrations now. You can see only one question we have been solving since. If I were to be in the physical class, of course, I know how I'm going to manage it, but I can't run faster than the way you are supposed to. I mean, so that you can understand this. That's what I'm taking my time. Even despite that, some of you are still saying that I'm too fast. Like I said in the past, it's my nature. I don't like. I don't know how to. I'm trying to adjust. You know. But in any case, let's see if you can solve one more. We can solve one more illustration, but let's wherever we stop, we continue next time. All right. So let me see. Ah, this way. Okay. Um, all right. So you can go to your, okay, let me see. You can go to your WhatsApp. The question I shared with you on Saturday, was it Saturday or on Sunday? Let's go through on Sunday, rather. That was yesterday. So let's go through that question together. At least we should be able to solve the A part of the question so that the B part in our next class, we finish the B part, then we do another one. So that will be the end of capital budgeting. So let me stop sharing this. Okay. Let me even see. Did I have? Let me see if I have. It's not in the study material. Okay. It's not in this one. Let me open the material at your hand, but let me open to Golden Book. Pick it from there. Okay. What's wrong with you? Okay. Which question is this? What question is that one, Seth? This one. Okay, this is Ferrari. No, we just finished this one. So, for example, now for those of you that have this golden ball, yeah, I have about 14 different practical question and answers here. So you can just go through all of them. They are all past questions and potential questions as well. So you can just practice them so that the more questions you solve, the more you get exposed to the scenarios. So that if you see similar scenario in your exam, of course, it will be faster for you to solve. You easily jump at it and move on. Okay, that will be a plus for you because oftentimes examiner do repeat questions. Yeah, let me see. The question I share with you is what I'm looking for, not this one. I think that's a Telemundo. Yeah, come in. I think I'm almost getting there. That Telemundo, the reason why I want to solve, yes, this is it. The reason why I want to solve it is because it involves we have modified internal rate of return. We have MPV. Okay, that's 15. Yes, I have 15 illustrations there. There are 15 different illustration in this material. So for those of you that have the material, you can always ensure you go through all of them. Okay, let's see what we can do quickly with this illustration. Let's see what we can do with this. At least we should be able to solve the A part. All right. So who is helping us to read this? Wumin, are you still on? Or you have disappeared? Who is helping us to read?
I'm here, sir.
Okay, Wumin, please help us. Start from the requirements. Okay, I want to teach you the exam method. So when you are given a question, don't start from the body of the question. Start from the requirement, because the requirement will prepare your mind on what you should look out for in the question. So start from the requirement.
Okay. You are required to A. Compute the appropriate cost of capital that Telemundo PLC should use to appraise this cement project, and state why you consider this rate more appropriate than the existing WACC of 11%. Note, your final cost of capital should be rounded up to the nearest whole number. State any assumptions made. B. Compute the net present value and the modified internal rate of return of the project, assuming a cost of capital of 13%, up to the nearest million naira. C. Recommend whether the project should be accepted or not, using both NPV and MIRR method.
Okay, so those are the requirements. So in the A part, you have to calculate appropriate cost of capital. In this case, I need to ask myself, what kind of cost of capital? Is it traditional WACC? Is it project-specific WACC? Is it WACC of the combined activity? Of course, the scenario in the question will direct us on which of the cost of capital that we should calculate. You can see this particular requirement is different from the one we just solved on Ferrari PSC. In that Ferrari, examiner was specific, telling you that examiner was direct in that one, that you should calculate project-specific WACC. But in this one, examiner only told you to calculate appropriate cost of capital. So you are the one that will determine which kind of cost of capital do you want to calculate, all right? So we then go to the body of the question and identify what kind of cost of capital that we want to calculate. Quickly, go ahead.
Okay, Telemundo PLC is a company listed on the Nigerian Stock Exchange. It is involved in property development and sales. The company currently imports more than 60% of its cement requirement. Okay, so as a recent meeting of the board of directors, the decision was taken to establish a division for the production of cement in Ore, Ondo State. If the division is set up and the cement production goes ahead, output from the division will be sold to Telemundo PLC and external customers at market price. For planning purposes, it has been decided that the financial viability of the project over the next 5 years should be determined. The sum of 2 billion naira would be required. The sum of 500 million naira will be spent to acquire an existing factory considered suitable for the project. The balance of 1.5 billion naira will be applied for the procurement and installation of essential plant and equipment. Tax allowance can be claimed on plant and equipment at a uniform amount over 5 years with nil scrap value. A total of 20 million naira has been spent on various surveys, market, technical, financial, etc. to date, out of which 10 million naira has been paid. The balance of 10 million naira is due for payment at the end of year 1. Production of cement for the next 5 years is projected as follows. All figures are assumed to be correct. A bag of cement currently sells for 2,000 naira in the open market. This price is expected to increase at the rate of 5% per annum. The variable cost is now 800 naira per bag. This will increase at 4% per annum. The fixed overhead cost will be 50 million naira at current prices, but will rise by 8% per annum. Apportioned head charges of 25 million naira at current prices will rise by 10% per annum. 50% of the Total initial outlay of 2 billion naira is to be funded with a loan from the Federal Government Development Bank at a concession fixed interest rate of 8%, payable at the end of year 5. The project will require a working capital of 10% of annual revenue, and this should be available at the beginning of each year. The company uses a current weighted average cost of capital of 11% to appraise all capital projects. The asset beta of the company is 1.2, equity beta is 1.6, risk-free rate is 5%, while the market risk premium is 7%. The financial director is of the view that it is not appropriate to use the existing WACC to appraise the new project. He has identified a listed company which currently produces cement and packaged food things. The company has the following financial statistics: equity beta of 1.82, debt beta of 0.40, debt to equity ratio 40%. 60% of the market value of the company is attributed to cement production, while 40% of the value is attributed to the fruit drink division. The fruit drinks division has an equity beta of 0.8. The new project is expected to move Telemundo to the target debt equity ratio of 30%. The tax rate is 25% for the two companies and is paid in the year profit is made.
All right. Thank you very much, Wumi. So again, you can see this is a very big question. Of course, it's expected, it's a compulsory question. So you can't have it shorter than this in terms of volume. So, okay. So in the A part, we want to calculate appropriate cost of capital. Let me switch quickly so that we can, within the next few minutes, we are done with this. All right, so we want to calculate cost of capital. That's what the examiner asks us to do. So, yes, solution to Telemundo. Question. Okay. So in this case, I would then say number A, the name of the company is Telemundo PLC. Then I would then say number A, examiner is asking us to calculate appropriate cost of capital. I need to go back to the question and identify which cost of capital do I want to calculate, because I know for certain that if I'm given information on capital structure of a company, I have ordinary share capital, preference share capital, debt capital. I also have their underlying cost. I can see dividend, I can see interest in the question. That means I'm supposed to calculate traditional WACC. I will go back to the question. If I can't find that one, then let me check whether it is project specific. If it is project specific, it means that the company is diversifying from one industry to another industry. The company is moving from one industry to another industry. In that case, I need to calculate project specific WACC. If I can't find in the question that the company is diversifying, then it is possible that the company is engaged in several activities, in several business activities, or in different business activities at the same time. So in that case, I'm supposed to calculate WACOCA. But yes, in this first paragraph, examiner has told us that Telemundo PLC is a company listed on the Nigerian Stock Exchange. The company is involved in property development and sales. The object clause, what the company does, what Telemundo PLC does currently is property development and sales. So you are now told that the company currently imports more than 60% of its cement requirements. At a recent meeting of the board of directors, the decision was taken to establish a division for the production of cement. So this company is into property development and sales. But the company is now thinking on diversifying into the production of cement in Ore. So that means An examiner is asking me to calculate cost of capital, it means that I'm supposed to calculate project-specific cost of capital. You can see the way we are picking it, because in this question, Telemundo PLC is into property development and sales. The company has now agreed at a board of directors meeting that they should establish a division for the production of cement. The company does not produce cement before. Now they want to start producing cement. That means they are diversifying. All right. So in this case, we want to calculate project specific work. So if that is the case, then let's solve. The first step is we should identify proxy beta. So I'll just come here, calculating project specific cost of capital. Okay, that's what we want to do. Then step 1 says we should identify the proxy beta. I will then say proxy beta. So let's go back to the question and identify the proxy beta. Okay, so according to the question, we go straight. So we are told in the question that the finance director is of the view that it is not appropriate to use the existing work to appraise the new projects. He has identified a listed company which currently produces cement and packaged food drinks. This proxy company produces cement and packaged food drinks. You have to be very careful. You are looking for proxy beta. You have been given a beta of, you have been given an equity beta of 1.82. That 1.82 is not beta of cement, because Telemundo PLC is diversifying into production of cement. You are looking for beta that measures cement industry. The proxy company that the finance director has identified produces cement and packaged food drinks. Packaged food drinks and cement is not the same product. They are not from the same industry. Cement production is different from packaged food drinks. Therefore, the 1.82, the equity beta of 1.82 given to you is a combined equity beta. That 1.82 is meant for cement and packaged food drinks. So since you don't have, in this question, examiner did not give to you the beta of cement, you are given beta of both cement and packaged food drinks. So we cannot use that 1.82 as a beta for cement because it's a combined equity beta. Therefore, since you are not given, how do you then calculate it? So you need to use known variable to get the unknown variable. All right? What are you supposed to do? You will recall that when we calculated WACOCA, weighted average cost of capital of combined activities, the step 4 states that you should calculate weighted average asset beta or asset beta of the combined or combined asset beta, whatever you want to call it. That formula that we use to calculate combined asset beta is the same thing we are going to use, is the same thing we are going to use to get this number, to get the value you are looking for, to get the equity beta of cement. All right. So without wasting time, because we have few minutes to round up, let me come here. So let me just help you. Let me put it down for you. Proxy beta of cement. Okay. I will then say the proxy beta of cement is not given. Okay, it's not given. However, the following information relating to the proxy company, can be used to determine the beta of cement. Okay, so what are the information? According to the question, you are given combined equity beta. Okay, this beta is for cement Beta of cement, let me put it properly. Beta of cement and fruits and packaged food drinks. Let me shorten it, which is equal to 1.82. Not only that, examiner has told you that we are looking for beta of cement. Beta of cement is not given, unknown. Then beta of fruit drinks. Beta of fruits, let me readjust this. Cement, which is C. Cement is C. Beta of fruits, which is F. Okay, this one is unknown. Then beta of fruits, according to the question we are told is 0.8. Equity beta of fruits. Let me put it properly. It's equity beta, not just beta. Okay, well, let me just move on. Then not only that, you are also given market value of cement to be equal to 60%, according to the question, which is 0.60. You are given market value of fruits to be 40%, 0.40. So with this information, I can go ahead and calculate equity beta of cement. So like I told you, you will recall that when we calculated WACOCA, weighted average cost of capital of combined activities, the step 4 says we should calculate weighted average asset beta. So to do this, to get, let me just show, to get the equity beta of cement, the formula below can be used. There is no one way of solving a question, so you can use another approach to get the value. In fact, in ICAN Pathfinder question, a different approach was used, but in that one, they don't use any formula. But here, since there's a formula you can use, all you need to do is to think outside the box, all right? So since there's a formula you can use, then I prefer to use formula instead of using known to get unknown. All right, so I would then say, of course, in that formula to calculate weighted average asset beta, you just say beta combined equity beta equal to beta equity of cement multiplied by total market value of equity and debt of cement. You remember this formula, divided by total market value of cement and fruits on one side, plus, open a bracket, beta equity of fruits multiplied by total market value of equity and debt for fruits divided by total market value of cement and packaged food drinks. So you remember this formula now. So that's it. So we have been given combined equity beta to be 1.82. So here will be 1.82 equal to, we are looking for beta equity of cement because it's not given to us. I will then say beta equity of cement multiplied by, we are told in the question that cement, market value of cement is 60%. 60 divided by 100 will give us 0.60. Okay, on one side plus the other side. Beta equity of fruit drinks we are given 0.8 multiplied by market value of equity and debt of fruits. Examiner told us is 40%, so 0.40. Who said SFM is difficult? It's not. Just find a way to, once you have the understanding of how to interpret question, then you are good to go. And at the same time, you must be ready and willing to memorize formulas, all right? Because SFM is formula driven. If you cannot memorize formula, then you can't do much in SFM. So in that case, you need to sharpen your brain to be able to accommodate as many formulas as possible. So this one will be 0.60 BEC plus 0.32. Okay, so I will just collect like times. All right, I will collect like times. So here will be 0.60 BEC equal to 1.82. Hold on with your question. Let's finish this. It's already time. So minus 0.32. All right. So here will be 0.60 BEC equal to 1.50. Okay. When you minus 1.82 minus 0.32, give us 1.5. Therefore, beta equity of cement is equal to 1.50 divided by 0.60. What do you have here? Minister of Finance, Wumi? What's the answer?
2.5.
2.5. 2.5 is the beta equity beta of cement. This is what examiner has hidden for you. This is what examiner has hidden for you. And that's why we see that the requirement is 12 marks. So that's what examiner has hidden for you. I noticed, so Charity is asking, I noticed that we didn't consider denominator. There is no need for denominator again now. I've already explained. See it here. You are told that market value of cement is 60%. 60 divided by 100 will give you 0.6 now. So there's no need for me to do 60 over 100. That's a waste of time. Okay, I understand your point, Charity. So 60 divided by 100 will give you 0.6. So there's no need to put on 60 over 100 again. All right? I believe that is clear, Charity. Now, now we have identified the proxy beta. The beta is 2.5. Step 2 now says you should ungear if the beta is geared. Of course, this beta is geared. Why? Because we are given that equity proportion of 40%. Okay? According to the question, examiner has given you that equity proportion of 40%. So if that is the case, it means that this 2.5, this equity beta of cement of 2.5 is geared. Why? Because you are given that equity proportion of 40%. So if it is geared, you need to ungear it. So before I put down my formula to ungear, I need to check from the question if I'm given that beta. Yes, examiner has given us that beta of 0.4. That means we are supposed to use the extended formula. Therefore, I will then come here. We want to ungear to remove financial risk. So I will say, since, just for your own, on the day of your exam, well, if you put it down like this, no qualms. But again, you don't have time. So I will say, since that beta of 0.4 is given for the proxy company, okay, the asset beta, okay, will be calculated using the formula below. This is for your own information, so that you know the reason why we are treating it this way. So this guy is the determinant of formula you are going to use. All right, so I will then say beta asset, I want to ungear, is equal to, because we are given that beta, we use the extended formula. So beta equity of a gear multiplied by equity value over equity plus debt, 1 minus tax on one side, plus the other side, debt beta multiplied by debt value, 1 minus tax, over equity value plus debt value, 1 minus tax. So this is the extended formula you are supposed to use to calculate asset beta, where debt beta is given. like in this case. So in this case, I would then say beta assets equal to the beta equity of a gear we have identified in step 1 is 2.5. Here is 2.5 multiplied by, I need equity value of the proxy company. According to the question, we are given debt equity proportion of 40%. It means that debt is 40%, equity is 60%. So equity value is 60 divided by 60 plus debt value 40. Tax rates, according to the question, is what? What's the tax rates? 25% for the two companies. So tax rate is 45% for the two companies. Sorry, is it 25%? Let me check again. Yes, 25% tax rates. So that means we are supposed to account for 75. Okay, for the left side. Then the debt beta is 0.4. 0.40. All right. Then multiply by the debt value, 40. 1 minus tax, 0.75 over 60 plus 40. 1 minus tax, 0.75. That's it. I will get my answer. Who said SFM is difficult? It's not. Just take your time. All right. So 0.75 multiplied by 40 equal to 30. So 60 divided by 90. All right. 60 divided by 90 equal, then multiply by 2.5 equal, that's 1.67. Here is 1.67 for the left. The other side, 30 divided by 90. That is 40 multiplied by 0.75 is 30. Then 30 plus 60 will give us 90. So 30 divided by 90 will be equal to, then multiply by 0.4 equal to 0.13. 0.13. Therefore, beta assets equal to 1.8. Here is 1.80. That's the asset beta. You can see, move to the next one. Step 3 says we should regear. So I say regear. Now, to regear, I will go back to the question if I'm given debt beta for Telemundo. According to the question, we are not given debt beta for Telemundo. It means that debt beta is risk-free for Telemundo. So again, you have two options. Since you are not given debt beta for Telemundo, you can assume that debt beta is risk-free. Number 2 option. The second option is that since you are not given debt beta for Telemundo, you can assume the debt beta of the proxy company, which is 0.4. All right. But again, you don't need to be stressing yourself. Since you are not given debt beta for Telemundo or for the main company, then it is assumed to be risk-free. Therefore, I will come here. Debt beta for Telemundo PLC is not given. Therefore, it is assumed to be risk-free. Okay, whatever your assumption is, you have to state it after your calculation. It's assumed to be risk-free. That's it. So if that is the case, so the formula below should be used. Hence, the formula below is used to calculate the beta equity of a gear. The formula below is used. Okay. Okay. So I would then say beta equity of a gear equal to beta assets multiplied by 1 plus 1 minus tax multiplied by debt equity proportion of Telemundo, which is the main company. So beta assets equal to beta equity of IGEA, we calculated 1.8. Here is 1.80 multiplied by 1 plus 1 minus tax, 0.75. So I need debt equity proportion of Telemundo. According to the question, we are told that in the last paragraph of the question, you are told that the new project is expected to move Telemundo PSC to the target debt equity ratio of 30%. It means that debt is 30%, equity is 70% for Telemundo. So debt is 30 divided by equity 70. All right. So beta asset for Telemundo would then be equal to 30 divided by 70 equal multiplied by 0.75 equal then plus 1 equal multiplied by 1.8 equal to 2.38. Here is 2.38. That's the beta, sorry, I'm writing beta asset instead of beta equity of a gear. This is BEG, beta equity of a gear. I trust you. Some of you have disappeared. All right. Then step 4. Step 4 says you should calculate cost of equity using capping. So we're almost there. Cost of equity equal to risk-free rate of return plus beta multiplied by market return minus risk-free rate of return. Okay, according to the question, our risk-free rate of return given to us, what do we have there? Minister of Finance. Our risk-free rate of return, where is that information? Yes. The asset beta of the company is 1.2. I don't need that. Equity beta, I don't need those ones. Risk-free rate of return is 5%, while market risk premium is 7. Okay, so risk-free rate is 5% plus beta of 2.38. The difference between market return and risk-free rate of return, examiner has given us as 7. Therefore, cost of equity is equal to 7 multiplied by 2.38 equal, then plus 5 equal to 21.66. Here is 21.66%. Then
That's not
finally,
what I got.
do it again. That's the answer. You can do it again. So, final step, you calculate WACC, project specific WACC. So, KW equal to equity value over equity plus debt multiplied by cost of equity. Yes, have you gotten it now?
Yes, sir.
Okay. So
Thank you.
plus debt value over equity plus debt multiplied by cost of debt, 1 minus tax. Okay. So WACC equal to, we have the examiner has told you that debt equity proportion of Telemundo is 30%. So debt is 30%, equity is 70%. So 70% is the same thing as 0.7. All right. Like one of you asked me the other time, why didn't I include the denominator? Okay, to avoid that again, let me do 70 over 100. If debt is 30%, equity is 70%. So 30 plus 70 will give us 100. So here is 100. Multiplied by cost of equity of 21.66% for the left. Then we do for the right. Plus 30% divided by 100%. Then we need cost of debt in the question. According to the question, Wumi, Minister of Finance, what's cost of debt? Charity, go to the question, give me cost of debt quickly. What is cost of debt? Cost of borrowing.
8%.
Pardon?
8%.
8% is the cost of borrowing. Thank you, Gerard Chinozo. So how do you arrive at 8%? You can see from that question, examiner has told you that 50%, let me see the paragraph. Okay. Just look for the paragraph. That's on page 179 that I share with you. So 50% of the total initial outlay of 2 billion naira is to be funded with a loan from a federal government development bank at a concessional fixed interest rate of 8%. So the interest rate is 8%. All right, that's your cost. That's the cost of borrowing for Telemundo. All right, so 8%. So in this case, I would then say multiply by 8%, multiply by after-tax cost of debt is 0.75. All right. So from the left, I would then say 70% of 21.66 multiplied by 0.7 equal to 15.16. Here is 15.16%, then plus the right side. The right side is 0.3 multiplied by 8 multiplied by 0.75 equal, that's 1.8. Here is 1.8%. Therefore, my work will then be equal to what I have in my calculation is 1.8 plus 15.16 equal 16.96. Here is 16.96%. So examiner says we should round our number. Let me go back and check with the question. In the requirements, you are told that note, your final cost of capital should be rounded up to the nearest whole number. State any assumption made. All right. So here will then be my total, my work will then be equal to, it will be approximately 17%. So I can say that the appropriate cost of capital is approximately 17%. Okay, so that's this. This is how to calculate project specific work. Again, in these requirements, the question is 12 marks. You cannot earn your full 12 marks if you don't state your assumption, because the examiner is asking you to also state any assumptions made. All right. Even though your calculation will carry more marks in this instance, but your assumption may be like three marks or even 3 marks. So you need to state your assumption. All right. What assumption have you made in this calculation? What assumption have you made? All right. So I can say assumption quickly within the next 2 minutes. We are done. On the cost of capital we just calculated, we made assumption. What are the assumptions? We can talk about debt equity proportion. Okay, we can talk about debt equity proportion. What do you mean by debt equity ratio? Debt equity proportion. So I can then say the debt equity proportion of the proxy company and Telemundo PLC are assumed to remain constant. Assumed to remain constant. Okay, it will not change. We are given debt equity proportion of the proxy company to be 40%. Debt is 40%, equity is 40%. So our assumption is that it will not change. It will be the same as 40%. Then for Telemundo, debt equity proportion given to already is 30%. Debt is 30%, equity is 70%. So that's our assumption. All right. If you like, you can put it there. Okay. You can rewrite it where you have the debt equity proportion of the proxy company. You can put in brackets 40 to 60. So that is that you are specific. Then Telemundo, you can do is 30 to 70. All right. So that you are specific with your explanation. Okay. Then another assumption we made is about business risk. Okay, we made that assumption of business risk. So you can say it is assumed that the proxy company and Telemundo PLC have similar business risk. Okay, that's why you are borrowing the beta of the proxy company. Okay, so that's that. Again, the third assumption, debt beta. So I would then say the debt beta, let me write it. The debt beta of Telemundo PLC is not given. Therefore, it is assumed to be risk-free. Okay, so any other assumption that you have made in this calculation of cost of capital, you state it there. So it is only when you do this that you can earn your 12 marks. All right. So that is as per that. Yes. Somebody is asking a question. Let's close the class. Sir, it's not the same as I do your calculation again now. It's the same thing. That's what I've gotten. So if Charity is asking, so if you calculate it once, you do it again just to confirm whether it's correct or not. Okay. Yes, this is the end of requirement number A question. So by the grace of God, in our next class, we are going to complete the question, then we solve another question. So that will be the end of capital budgeting. So let me know if you have any question for me before we close the class. I've already extended beyond your normal closing time. Okay? Talk to me quickly if you have any question for me. If not,
There's
we
no
close.
question, no.
Pardon?
There's no question, no.
There's no question.
Yes, sir.
Okay, I want to believe there's no, because I think that's the Charity. The only thing that Charity does in my class is to ask me questions. If I ask you to read, you will not read. You only bother me with questions, but it's okay. All right. So any other questions so that we can close the class? Okay. All right
There's a
then.
question.
Okay, Emmanuel, talk to me quickly.
Sir, this thing is heavy, honestly. Because imagine solving this thing in the exam hall at that limited time.
No,
I've been
it's not.
for some time now.
It's not heavy. There's nothing there. So that's what I was encouraging you the other time, Ima. That's what I was
Yes,
encouraging you the other time. You need to, practice make perfect. Practice makes perfect. So if it's something you do often, if I'm the one solving this, I can't spend up to an hour. I can't spend more than 45 minutes on this, no matter how big it is, because I'm used to calculation. Something I've practiced questions, several questions. I know the approaches that I what I can how the approaches or the steps I should take to solve a question. Rome is not built in a day. And that's what I'm encouraging you, that you need to start reading, practicing. It's not difficult. Less than an hour, less than 50 minutes, you are done. Move to the next one. And that's why we always encourage you. You don't start calculation. You don't start solving your question on the day of the exam with the compulsory question, because it will throw you off balance. When you are in the class, the beauty of ICAN program is when you are in the class, you'll be enjoying the class, you'll be enjoying the lecture, you mingle with your colleagues in the class and all of that. But on the day of your exam, you'll be on your own. You are working under immense pressure. You'll be sweating under AC, right? Under air conditioner, you'll be sweating like e-goat because you are under pressure. But if you have practiced several questions, you have exposed yourself, the class questions that you solve, the question you have in your textbook, in the ICAN study pack, all the Pathfinder question and answers, even ACCA questions. So you are already exposed. You are ready for the exam. So when you have a question, if provided you understand the requirement, every other thing is simple. But if you don't know, if you don't understand the requirement, it will be difficult for you to articulate your point. You just be doing it anyhow. So I will encourage you to practice as many questions as possible for you to gain your confidence. It's not difficult. It's because I'm answering your question. If I'm the only one solving this, I can't spend more than 45 minutes, because you need to time yourself. You need to time yourself. You can't be, I can't, if I spend 1 hour on this, how many hours am I going to do? The remaining 2 hours, I will not be doing 30 minutes for the remaining 4 questions. So you just have to practice as many questions as possible for you to gain your confidence. It will really help you a lot. It will really help you. All right? Emmanuel,
Thank you, sir.
you are welcome. Okay. Yes, that is that from me to you. Before I call it good night. Aisha, have you received it? Aisha, hello, Aisha.
Hello?
Have you received the material?
He'll be taking it to the office tomorrow. So I've made arrangement to send it to Kaduna.
It's okay, no worries. All right then. Thank
Thank you
you.
very much. Yes,
You're
sir.
welcome. Yeah. So, in the absence of no further question, I want to say thank you everyone for waiting behind for the end of today's lecture. I will see you next week again by the grace of God, when we shall be concluding this topic. All right. Thank you everyone. Good night.
Good night, sir.
All right. Good night.
Good night, sir.
Yeah. Good night, Charity.